I'm Anthony Valeri, Director of Investment Management at Zions Bank Corporation. Thank you, everyone, for joining our Fall Market Outlook webinar. I'll spend the next 25 minutes going over our thoughts on financial markets with a quick review and outlook for the coming quarter and beyond. We'll have time for Q&A at the end. So let's go ahead and get started with our webinar. We'll start with a review of investment performance for the third quarter of 2024, and it was a good one for investors with all markets in positive territory, or all major sectors in positive territory. If you look at the strength, we saw it in real estate bouncing back from a depressed level. But most notably, you'll look here on the fifth from the right, the S&P 500, which we use to measure U.S. large caps, up 5.9%, which is a solid quarter. But in a change from recent quarters, a number of other asset classes actually outperformed U.S. large cap stocks. So for diversified investors, it was a very good quarter with strength across small cap, mid cap, and emerging market stocks. The S&P 500 equal weight also had a good return, up 9.6. And we saw a bounce back in fixed income asset classes too, as interest rates fell over the quarter. If we look at sector performance, we can show the breadth of gains in the equity market. So a broad-based rally over the third quarter with some sectors that had lagged outperforming, notably utilities, real estate, and industrials. If you look at the overall index, you see it's towards the bottom, and most notably, third from the bottom, technology up 1.4% for the quarter. The first time in 18 months that technology was not among the leaders on a sector basis. So a big change in terms of the composition of return within the equity market. And again, for diversified investors, it finally paid off to stay diversified. We continue to think that it will and would behoove investors to stay diversified. So a change up in the market for the third quarter. When we look at year-to-date investment performance, however, returns have narrowed across asset classes. But if you look to the left, you still see that U.S. large caps lead by a notable margin. Still a very good year for U.S. large caps. That's the S&P 500. Should note it is the strongest 9 months since 1997 for the S&P 500. But good returns across the board, emerging markets, mid-cap. The equal weight also benefited on a year-to-date basis from that better diversification. And then on the way to the right, you can see even bonds now positive after a sluggish start to the year. So a good quarter for investors and a good year for investors. Again, that diversification starting to pay off for investors on a go-forward basis. Now let's start to look at the economy, and economic growth has been strong. The blue bars represent the actual GDP growth numbers that have been observed for the quarters ending, as you can see there. The second quarter ending in June had a above consensus result, up 3%. And the Atlanta Fed GDP Now indicator of the third quarter, which we won't get data yet for another couple of weeks, showing that the economy is tracking to about a 3.2% growth rate. That also above the gray bar, which is the Bloomberg consensus forecast for economic growth. So a strong economic growth. It certainly has picked up since late 2023, and the economy continues to defy the skeptics who expected a slowdown. The economy looks very healthy. We do not see a near-term recession. You do see the consensus forecast does call for a slowdown, particularly in the fourth quarter of this year. We think that is likely, but the economy has been resilient, so wouldn't be surprised to see some modest above trend growth going forward. A little less strength in the labor markets, some hesitation on business investing ahead of the election, contributing to a slower pace of growth. And I think it's normal that we would see a slowdown in economic growth, but do not be discouraged by 2% GDP growth, which is still a favorable backdrop for investors in financial markets. Moving to the labor market, it's been remarkably resilient. Early August saw a sell-off in the equity market on a weak jobs report, as investors believed that might be the sign of a recession. Well, lo and behold, the September report was very strong, exceeded consensus forecast by 100,000. You can see the 3-month rate of change moving higher. The September payrolls report also included upward revisions to the August payrolls as well. So the jobs market looking healthy based on the monthly payrolls report. No sign of material weakness in the labor markets, and we continue to see good job growth. But there are some signs of slowing within the labor markets. If you look at job openings as represented in the JOLTS survey, you can see that job openings have decelerated. They remain high on a historical basis, so you can't call this absolute weakness. But the Fed likely took note of this when they lowered interest rates in September. We'll get more on that to come. And the unemployed looking for work slowly creeping higher. So at the margin, you are seeing some signs of slowing within the labor market. Another statistic within that JOLTS report talked about the quits rate dropping to a new post-pandemic low, and that's the measures job seekers who voluntarily quit their jobs, and usually viewed as a sign of confidence in the labor market. We've seen the quit rate gradually decline over the last several months, which again is another sign that the labor market is slowing. But if you need the one indicator we are watching most closely, that would be our first early warning sign of any weakness in the labor market, and again, have not seen it, would be in the weekly jobless claims data. And weekly claims outside of last week's number have held very near historical lows, not seeing any trend upward that would portend sustained weakness in the labor market. This is a good sign for the economy. However, a bit of caution after the recent hurricanes, and we saw it last Thursday's print, an increase in weekly jobless claims. We may see jobless claims remain elevated for a couple weeks, so this indicator will be a little murky for the next few weeks as we try to ascertain the true level of jobless claims. As you can see on the left side of this chart, it's not uncommon to see an increase in jobless claims following hurricanes. So this indicator may be distorted, but again, a key watch for any early signs of weakness in the economy will be weekly jobless claims. That solid labor market has been a underpinning of for the consumer, and the consumer is still a workhorse for the economy, has been a pillar of strength. This is monthly retail sales data, excluding more volatile auto and gas purchases. And you can see that retail sales, 3% growth on a year-over-year basis, holding steady over the last several months. Again, no sign of weakness here. Consumer spending strong and continues to support the economy. Even if it has slowed from the pace of 2022 and 2023, this is still a healthy level of consumer spending. And when you start to think about why has the consumer remained so strong, you really have to look back to a number of factors. One is the fact that most consumers have locked in low interest rates back from the pandemic and beforehand. Gas prices are the lowest since 2024, and in turn, the lowest since 2021. We've had notable wage gains and, of course, wealth gains, both from financial markets as well as a strong housing market. Even if it's slowed, housing prices have helped support wealth gains for consumers. So the consumer on a healthy trajectory, continue to doing its part to support the economy. And if that wasn't enough, inflation moving lower, we still think we get a little bit more of a drift lower in inflation. The overall consumer price index at 2.4%, pardon me, as of the end of September. The core CPI at 3.3, a little higher. That gold line owner's equivalent rent has really been a factor in maintaining a higher inflation rate. That should continue to creep down as we've seen rent increases, yes, come down to flat year over year or marginal gains. So a bit of a tailwind to see additional declines in inflation. But the bulk of the declines in inflation likely behind us. We'll see inflation likely flatten out to about a 2.5 to 3% pace, closer to 2.5 going forward. But this too has been a little bit of an easing for consumers. It's also paved the way for the Fed to lower interest rates. So a positive going forward. When we look at other segments, high level and manufacturing is actually a weak spot in the economy. This is the ISM Manufacturing Index, and a reading below 50 indicates contraction, above indicates expansion. And you can see manufacturing still below that expansion contraction line. A recession typically is indicated in the low 40s, so we're not there. But with the Fed lowering interest rates, that should help manufacturing. The services sector, on the other hand, still very robust, and a reading of 55 and indicative of above average growth. So when you look at the broader economy, yes, manufacturing weak. consumer still doing their part. We'll likely see continued economic growth. And again, no recession on the horizon. Wouldn't rule it out entirely. It's still a risk for later in 2025, perhaps, but the economy is still looking quite firm. Let's turn to the equity markets, and we'll start with a look at valuations. And a good chunk of the equity market, no surprise to those who follow the market regularly, still expensive. The little squiggle there on the right, that is the Mag 7. That's the price to earnings ratio of those 7 stocks. You can see very elevated and expensive by this metric, by the PE ratio. They're still very profitable and they still generate very strong earnings growth, but you are paying a lot for those stocks. And the markets, that rotation away from tech and those big stocks over the third quarter is a reflection of that. The blue line represents the market cap weighted index, which weights the bigger stocks more, and certainly the top 10 have had an outsized influence. And the gray line looks at the rest of the equal weighted market, rather, and that is roughly in line with the historical average. So not an expensive market on that metric. We think it's fairly valued, maybe slightly expensive when you look at the broader equity market. So good context to have as we look at earnings, which for us is always the key metric for equity investing. And when we look at earnings growth, it's been very strong over the last few quarters. The light blue line represents the actual earnings growth rate of the S&P 500. The darker blue represents the estimates or the consensus forecasts at the start of earnings season. And you can see the last 6 quarters have seen very significant beats relative to that forecast, and that speaks to the strength in earnings. Corporate profit margins are still wide, and this earnings growth has propelled the stock market higher. Now, as we begin the third quarter, you can see the bar has certainly been lowered for the third quarter of 2024, and earnings season just kicked off for the third quarter last Friday. If we get the historical average of a 3% beat rate, which would mean 7% earnings growth rate, that would still be a good result. But do note that 3 quarters of double-digit earnings growth, which we are just coming off, is a very strong signal indeed. And profit margins remain relatively wide, so we should see continued earnings growth. One note of caution as we move forward, you'll see the consensus forecast for the fourth quarter of 2024 and the subsequent first and second quarter of 2025 call for some notable earnings increases. I think it's expected that those are going to come down fairly substantially, but we still see high single-digit earnings growth on a go-forward basis, which again should be supportive of additional equity market gains. We saw the rotation in the equity market over the third quarter, and a lot of that was the stock market moving in anticipation of this. The fact that profits outside of the Magnificent Seven would improve relative to those big 7 stocks. You can see the light blue line showing that profit gap is supposed to narrow in the third quarter and remain relatively narrow over the coming quarters. We'll, of course, monitor this as just a forecast, but it does go a long way that the markets are anticipating a broadening in profit growth, which should be healthy for diversified portfolios, not just those that chase the biggest names. So this broadening of earnings should be supportive of diversified equity portfolios. Let's move to the fixed income markets, and the decline in bond yields is largely behind us. This chart shows the 2- and 10-year Treasury yields, and the horizontal line represents vertical line represents when the Fed cut rates. And lo and behold, Fed cuts rates and market rates go higher. 2- and 10-year Treasury yields move higher following that announcement. A bit counterintuitive, but we'll go more into that in a moment. If you look at this chart from a longer-term perspective, going all the way to 2023, we view this more as a range-bound environment for bond yields. So yes, bond yields have come up over the last couple of weeks. Do we see them going back to the highs of 2023? No, without a severe inflation bout, which we don't see. We're really seeing this more of a range-bound market. When yields fell as they did, the 10-year getting down close to 3.5, that was probably too far given the underlying strength in the economy. And therefore, we see more of a range-bound environment for bond yields. So the decline is largely behind us. To get a further decline or a renewed decline in bond yields, we'd like to have to see a recession, which again, is not our base case. So we might see an additional bump higher in bond yields, but do put it in the context of what we expect to be a range-bound environment. Now back to why didn't bond yields move, or why did they move higher? And that was simply because of the big rate cut expectations that were built into the market right before the Fed decided to lower rates. You can see, or in this chart, we show the spread between the 2-year Treasury and the target Fed funds rate. When this spread is negative, or when the line goes down, that means the market is pricing in rate cuts, and vice versa. When the line goes up, that means the market is no longer pricing rate cuts, but rather rate hikes or fewer rate cuts on a go-forward basis. The red line shows 2024, and you can see compared to the prior start of Fed rate cutting campaigns that the 2024 episode is by far the most severe in terms of how negative the 2-year, how far the 2-year Treasury yield was below the target Fed funds rate. So a lot of rate cuts priced into the market. And when the Fed pushed back on that overly optimistic market environment, we saw the reaction in bond markets. In fact, only 3 and 6 month yields out to 9 months actually declined following the Fed rate cut. And that's likely where you'll see some further declines. But again, as far as market yields, 2 years, 1 year, 2 year and longer, we're likely in a range-bound environment. So a lot of rate cuts priced in. And we still have a lot of rate cuts priced in at the beginning of October. This is what the futures market is telling us about the path of the overnight target Fed funds rate. The light blue bars represent January of each year. According to futures, we have another 25 basis point cut in November coming, and another one in December before another 1 percentage point or so of cuts in 2025, with some additional cuts in 2026. We do see the Fed, or the market actually sees Fed's funds target rate settling out about 3.25, 3.5. We think it might be a little higher than that given the ongoing strength in the economy, but still expect those short rates to continue to move lower. So what do those Fed rate cuts mean if you're an investor? Well, if you move to look at performance following the first rate cut, we can get a guide of that. If we look first at equities and we look at large caps in terms of the S&P 500 and then small caps, you can see as you move out to 3 months, 6 months, and a year after the first rate cut, that returns are positive, but they are subdued relative to history. The S&P 500 up 5.2%, below the longer-term average of around 10%. So a subdued return after the Fed cuts rates. I'll go more into detail on that in a moment. Conversely, it's been good for bonds generally. When the Fed begins to cut interest rates, somewhat intuitive, you've seen a better performance for bonds, and specifically high-quality bonds, either core bonds or short-term bonds. So we're mostly an intermediate. We feel that neutral exposure in terms of interest rate sensitivity will be a positive should we get a sell-off in the equity market, and would help diversified portfolio. So that is our focus in terms of a bond allocation going forward. And then when we take a closer look at equity market returns following the first rate cut, you'll see that a lot of it is really dependent on whether the economy goes into recession or we achieve the so-called soft landing. And the only 2 periods where we had negative returns after 1 year was when a recession ensued. So a lot of the success of the equity market on a go-forward basis will really depend if this rate cut campaign results, or coincides rather, with a recession versus continued economic growth. So really bifurcated results depending on the economic environment, as it should be. So important to note, you can't just take Fed rate cuts to mean one thing or the other. It really depends on the trajectory of the economy. And then one last point on fixed income. The high yield market is expensive. It's been a beneficiary of the risk-on environment. The yield advantage of the average high yield bond comparable to comparable treasuries fell to below 3% during the third quarter. As you can see on this chart, that is a historic low and well below the blue line, or lighter blue line, that represents the historic average. So the compensation for lower rated bonds simply isn't there. So within our bond portfolio, again, focusing on high quality intermediate bonds, yields not high enough to really lock in longer term yields. but you are not getting compensated for these lower rated securities, especially after another good quarter for high yield bonds. So important to put that into context. Now let's turn to the election. The presidential election is really a coin flip. This is predicted, showing betting odds. And yes, you can bet on the election outcome. So which party will win the White House? Well, it's been Democrats held an advantage. That has flip-flopped recently. However, that 5 percentage point gap, at least when it comes to betting markets, is within the margin of error. So it is going to be a very, very close presidential election race. It's going to be likely a coin flip. Which party will control, or Congress rather, is looking to be split. Looks like the Republicans, again, looking at election betting odds, set to take the Senate, whereas Democrats look to be ready to take the House. A divided Congress is substantial in the sense that it could restrict any kind of new or major policy initiatives. So important to keep that in mind. Whoever wins the White House or whoever wins the presidency would likely still inherit a divided Congress. What does this all mean for investors? Well, it doesn't really matter who's in power. And if there's one thing we can always leave you with when it regard to politics and investing, stock market does not care about your view of politics. It can impact specific sectors, but the stock market is not partisan. And we can see here that under a variety of political regimes, whether it's a Republican Senate, Democratic House, or Republican president on the far left, or a Democratic Senate, Republican House, Democratic president, second from the left, returns are fairly strong across the board. So under a variety of political regimes, equities have done well. Again, could caution against investing based on one's political beliefs. And on the far right, Democratic Congress, Republican president, which is a rare combo, has the lowest return, but still positive nonetheless. And as we look at what's really more substantive coming out of Washington, if there's one area that really needs a lot of attention, it's the budget deficit. No matter who wins the White House, both candidate Kamala Harris, Vice President Kamala Harris, or former President Trump, both are expected to maintain large fiscal deficits. And this is the budget deficit plotted against the unemployment rate, which we invert on the right. So what this says is that with a relatively low unemployment rate of 4.1%, that the budget deficit, which is roughly or expected to be roughly 6.1% at the end of the third quarter, is wide. Usually you see a large budget deficit during times of recession, and that's what these red circled bars indicate. You typically see the deficit increase when you have a recession, and that's normal as the government tries to stimulate to get the economy to grow again. But we have now had a number of years with a wide budget deficit and low unemployment. This will limit the ability of the government to stimulate the economy should we get a recession. It's also playing with fire in terms of the government and a still significant debt burden. Bond markets haven't rebelled as of yet, but it's something to note. And again, these large budget deficits are expected to persist based on policy prescriptions from either presidential candidate. So something to watch for the future. Those are my comments. Thank you, everyone, for joining. We'll move to Q&A, and let me bring in Head of Wealth Management, Rebecca Robinson.
Well, thank you, Anthony, and thank you for your comments. We've received a lot of questions in the queue, so I will kick us off. We talked a little bit about the election, but with the election just 3 weeks away and early voting having already started, a lot of people are still saying, what will happen to the market after the election? And I think one of the things that would be great to focus on is what are we seeing sometimes as short-term impacts versus what are the longer-term impacts of an election?
There has been a significant short-term impact, very consistent short-term impact. The long-term, there isn't one. It's ultimately been the economy, the level of interest rates, inflation, earnings growth that have driven equity prices. But we do have a demonstrable trend that in October and in November, volatility increases in a presidential election year. It is very notable in the presidential election year outside of the regular volatility trend. Saw a little bit pick up in October. We really haven't seen it too much otherwise, but we do usually see it in November. Markets react. There's a little volatility, both to the upside or downside. It's happened both ways. But once we get past December and move more weeks away from the election, that fades and it becomes a focus on the fundamentals once again. So short-term impact, yes, one way or the other, but in the long term won't have much of an impact at all.
And then another comment was made that while the overall market normalizes, some sectors could be impacted. And this may dovetail a little bit into what are the different outcomes if we were to look at a sweep versus a divided Congress?
And so the outcomes under divided, obviously much more narrower, and that's the highest probability outcome. But if we do get a Republican sweep or a Democratic sweep, which are low probability events, but they can happen, the budget deficit is expected to go higher under Trump, of about 7 to 9% is sort of the expected range, where it's a little less under Harris, maybe 7 to 8%. I think you'd see some green initiatives, renewable energy do better under Harris, whereas with Trump, maybe some of the domestic energy sectors might do better. Tough to call because that is a low probability event. And again, we're not bracing for that. We're expecting more of a divided government and don't see a real concentrated sector outcome.
All right, and that sort of leads into a policy question. What do we think the probability is of a debt crisis over the next 12 months?
Yeah, so probability of a debt crisis, I'd say, over the next 12 months is very low, but it is a real challenge and something that will be with the U.S. for beyond the 12-month horizon. We do have a structurally high deficit. The bond market really hasn't reacted in the form of, violent upward move in rates. Have seen that in the United Kingdom, have seen it in Italy and Spain. We, for now, in the U.S., benefit from a deep liquid treasury market, the reserve currency of the world in the U.S. dollar. But that won't go on forever if we continue to run large and growing deficits. So for now, the bond market hasn't reacted, but that is a risk going forward. Do we have higher than expected interest rates if this deficit spending isn't reined in?
All right, let's think about how this applies to investing. So we've seen cash hit some, at least in our near-term memory, record highs. So we've seen people holding cash. We also have seen some sectors, technology is one you mentioned, that for the first time in 18 months was underperforming the general market. But one of the questions is, are we better to hold cash predominantly? Are we better to be bold in a sector? And I think this really dovetails into, are you an investor or are you gambling? But how do we think about cash or sectors in the frame of the greater market?
Yeah, the old adage, are you an investor or a trader? And we get the cash question a lot, especially given the elevated nature of short-term rates. Cash outperformed in 2022, but there's only 2 other years going back to 1980 where cash outperformed everything else. It is very, very rare. And even with that outperformance in 2022, it wasn't long before a diversified portfolio outperformed cash starting in 2023. So we wouldn't certainly recommend it. If you are investing, if you have a future goal you're funding for, planning for, go ahead and have a diversified portfolio because cash over the long term is not a viable solution. Might look good shorter term. And keep in mind that cash rate's going to be coming down relatively quickly with these Fed rate cuts. So important to have a plan. And with regards to sectors, we do see clients that have had a nice run with a concentrated technology position, but I think it's time for that to change. We saw that in the market in the third quarter. That's a risky allocation. Yes, it's worked, but you're better off being diversified when you're thinking 5-10 years.
And I think that this kind of goes along that same line. The S&P 500 index has been very, very popular. And we discussed stocks maybe being expensive. And the question here is an S&P index fund still a good place to invest?
It is. It is still a good place to invest, but it shouldn't be your only place to invest, and would strongly recommend pairing it with some actively managed investments. It's been a long time since actively managed has outperformed. A lot of that due to the concentration in the market. But longer term, you do have these long periods of time where active outperforms passive and vice versa. we like to have both in a portfolio. We think they both work great together. So do use both in investing. And over the long run, we think that'll minimize volatility and lead to good results.
That's very helpful. Another very popular topic is interest rates, and you spent a lot of time talking about the Fed rate cuts and how they're already really priced in the market. Maybe they may have too many priced into the market. So I think it bears repeating. When we think about the Fed rate cuts, how do we see these impacting inflation? And then really, when you think about rate cuts for the fourth quarter or the next few years, I think this is a question everyone wishes they knew where they were going. But let's just really reinforce our view on rate cuts, what we're seeing, and put that in context of how does that really impact your investment plan?
Yeah, so a lot of rate cuts expected. The Fed has forecast a lot to take the overnight rate from its current 4 3/4 to 5 to down to 3.5 roughly. I think that's maybe a little too, or probably less than that, 3 to 3.5. We think it's probably a little higher. Maybe it's the mid threes, high threes. But a lot of that is factored into the markets already when you look at futures. That's why you've seen market yields, the 2-year, 10-year, move higher since the last Fed rate cut, because the Fed has said we're going to take a more gradual approach, and the economic data has been better than expected. So kind of as I mentioned in the webinar, we see it more as a range-bound environment. The 10-year Treasury maybe hanging out in the low 4% range. Do not see a repeat of the highs at 5% or higher that we saw in 2023. And really, to take yields lower or still lower, I think you need signs of a recession, something that really says the economy is heading into a recession. And I think that's the catalyst needed for even lower interest rates.
And I think, as you've said now, we're just not seeing those signs.
That's right. We're not seeing that. It's not our base case. It's possible it could be a later 2025 phenomenon, but from everything we see now, economy is doing quite well.
And then one final topic, and this really relates heavily when we think about interest rates, is housing, changes in the housing market. And I think this also dovetails into where do we see mortgage rates going? And I think understanding the difference between a move in a 2-year rate versus a 10-year rate that drives mortgages. But what do we see for the housing market, and maybe how do interest rate changes and other things really impact that?
Yeah, the housing market broadly would see limited growth. So some modest year-over-year price gains, but that's really about it. The higher mortgage rates have slowed that market dramatically. There looked to be some reprieve in September, just as sales were creating, but now lower mortgage rates were going to help. That's still the case, although in late September, early October, we've seen mortgage rates creep back up. But really, the main driver is the lack of supply in residential real estate, in housing, that is supporting prices and does not look to be solved anytime soon. So that limited supply is going to offset the lack of affordability, and I think will be a bit of a stalemate that translates into a period of very low single-digit year-over-year housing price gains.
All right. Well, thank you, Anthony. I know everyone will be anxious to watch the market over the coming quarter. Appreciate everyone joining. And as always, if you have any questions, please direct them to your Zions banker or our wealth management division, and we'd be happy to get back to you. Thanks so much for joining.
Thank you.